As the automotive sector grapples with a severe market collapse, car prices are set to plummet by a staggering 50%. That's right, an unattainable aspiration for many, but a grim reality for car manufacturers. What led to this sudden industry downfall, and how can you capitalize on this lucrative chance to purchase your dream car without incurring excessive costs? Prepare yourself for valuable insights as we delve into the causes and consequences of this explosive situation. Experts predict that the imminent wave of repossessions will mirror the auto loan crises of the 1920s and early 2010s, drawing attention to the striking similarities. In the early days of the automotive industry in the 20s, manufacturers and dealers were enticed to provide easily accessible financial options, resulting in a remarkable surge in car sales. However, the subsequent market crash brought calamity to numerous borrowers who struggled to meet their monthly loan obligations. This phenomenon spiraled into a significant decline in car sales, ultimately culminating in a prolonged economic depression. The historical events serve as a valuable lesson, urging us to brace ourselves for a comparable outcome in these turbulent times. The used car industry has witnessed substantial price surges since June 2020, primarily influenced by a combination of factors. Initially, attractive interest rates facilitated consumer financing for vehicle purchases, but the production of new cars suffered due to semiconductor supply shortages. Consequently, millions of drivers were compelled to take out high-interest loans for used cars, given the historically low levels of new car inventory. Such circumstances have propelled used car prices to surpass those of brand-new vehicles, resulting in an unprecedented used car bubble that has eclipsed the new car bubble. These price fluctuations pose significant challenges in terms of affordability and availability for consumers. With limited new car inventory and soaring demand for used cars, buyers have been paying exorbitant prices for pre-owned vehicles. The future of the used car market remains uncertain, given these developments. It is evident, however, that this scarcity has deeply affected the automotive industry, thrusting consumers into uncharted territory when it comes to purchasing cars. In today's used car market, many dealerships are grappling to stay afloat after paying inflated prices for their current inventory. Consequently, they are offering remarkably low prices for trade-ins as a means of offsetting their present losses. Unfortunately, this trend has persisted over the past few years, leading to a severe financial crisis for numerous used car dealerships that find themselves in a situation where the value of their cars is now lower than the original purchase price. The automotive industry is on the brink of a transformative shift, with vehicle prices, particularly for used cars, poised to plummet after an extended period of record highs lasting over 2 years. This shift can be attributed to a surge in new supply that entered the market from 2020 to 2022. Recent data released by Kelley Blue Book indicates that wholesale prices of used cars are expected to undergo a significant decline of up to 8.8%, influenced by various factors such as seasonality, mileage, and age. In January 2023, the average price of used cars sold stood at a staggering $27,156, representing a modest 1.5% decrease compared to the previous month. The report also highlights a slowdown in the rate of price growth in new car transactions, although still historically high. Average transaction prices reached a record-breaking $49,507 in December, before settling at $47,681 in January. If you're enjoying the video so far, please take a moment to hit that like and subscribe button. This projected reversal in used car prices signifies a pivotal moment for the automotive industry, deviating significantly from the established trend. Research conducted by Moody's reveals that the used car market is experiencing further decline due to weakened domestic consumer demand. Escalating borrowing costs and inflation have restricted households and businesses from making substantial purchases, intensifying the challenges faced by the already struggling used car industry. J.P. Morgan experts predict a potential 20 to 25% drop in used car prices and a potential 10% decline in new car prices in the coming months of 2023. Furthermore, concerns regarding the overall state of the auto loan industry have escalated in recent months. Despite the economic recovery following the pandemic, a significant number of Americans still face difficulties in meeting their monthly auto loan obligations. This has led to a further decline in auto loan performance, with delinquency rates rising within the past 30 days. These unfolding patterns paint a bleak outlook for the future of the automotive industry, as consumers grapple with financial uncertainty and mounting debt in the prevailing economic climate. Both new and used car loans are undergoing unprecedented shifts. Recent data reveals that the average interest paid throughout the lifespan of a new car loan has reached an all-time high of $8,436, while the average interest paid for a used car loan has also soared to a record-breaking $1,204. However, with the surge in interest rates and an increasing availability of semiconductors, the supply of used cars is on the rise. These factors have contributed to a substantial 8.8% decline in used car prices in the past month alone, marking the most significant monthly drop observed thus far. This current trend can be attributed to multiple factors, including an excess inventory of used cars, diminishing demand, and the semiconductor shortage that has resulted in delays in new car production. As a result, used car prices are trending downward, creating an opportune time for buyers seeking favorable deals. The auto loan market's current state is causing significant concern due to an unprecedented surge in delinquent loans, reminiscent of the global financial crisis 15 years ago. Startling data from Cox Automotive reveals a rapid decline in the market's health. According to the report, loans delinquent by over 2 months have skyrocketed by 5.3%, a 26.7% increase compared to last year. These staggering figures have sent shockwaves through the financial industry, attributing loan delinquencies and defaults as major contributors to this troubling trend. Wells Fargo, one of America's largest lenders, reported a higher loss ratio from auto loans in a recent earnings call, while Ally Financial, the nation's top car lender, experienced a devastating 50% drop in stock, driven by 4 times as many charge-offs in the third quarter. The outlook for the auto loan market appears undeniably bleak, with indicators pointing towards further deterioration. These alarming trends undoubtedly carry far-reaching implications for the wider financial sector, placing pressure on lenders and investors to acknowledge the crisis's substantial impact. Industry experts note that the market for used vehicles is rebounding and nearing pre-pandemic levels. However, this resurgence in value has led to a sharp decline in used car prices. Unfortunately, this trend has left numerous consumers who purchased vehicles in the past 2 years in a financially vulnerable position. The gap between a vehicle's value and the remaining loan balance has resulted in many being underwater, where the car's worth is less than what is owed. This precarious situation has the potential to ignite another crisis within the car industry, particularly for those who bought a vehicle at the market's peak and are now underwater. Trading in their car for a new one becomes challenging, as dealers may demand a significant sum to cover the difference between the loan amount and the car's value. For most consumers, this expense is simply unaffordable. These factors paint a worrisome and unstable picture for the car industry's future and those dependent on it. Preventing a full-blown crisis and its disastrous consequences for individuals and the broader economy will likely require significant changes. As noted by financial analyst Adamaya, the current state of the automobile industry is precarious, leaving dealers, consumers, and lenders in a bind. The inability to sell cars, buy vehicles, or secure financing has left the industry in a difficult position. Consequently, consumers have resorted to a risky practice of opting for a new car despite having an existing auto loan with another bank. This maneuver greatly increases the likelihood of loan defaults and subsequent car repossessions. With limited lending options, dealers have been compelled to increase repossessions in the used car market. The industry is currently facing a severe crisis that shows no signs of abating, posing significant challenges for all parties involved. Thank you for watching. Please remember to like, subscribe, and comment below. And be sure to check out our other content as well.